Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I have Scott with me, but he's looking a little bit different. He didn't eat his Snickers bar, and he's looking like a dog. So he's gonna
Yeah.
he's gonna do the interview as a dog today, um, and we're gonna talk about stagflation. So Scott, thanks for
Yeah.
coming back on. You're from
Thanks for having me
which?
back.
What's your website that you're from? It's Sow and Reap Capital, I think.
Yes. Can you please let me share
Oh
my
yeah.
screen? Thank
Yep. There we
you.
go.
So this is my new YouTube channel, Sow and Reap Capital. So here it
Yep.
is.
So if you want to subscribe, definitely check him out. He's big into uranium and other commodity areas, and also there's a religious aspect with it as well. So
Yes.
so talking about stagflation, let's first define what stagflation is. So what is stagflation? If you want me to define it, or you want to define it?
Yeah, go ahead.
So stagflation is basically a recession with inflation, or really slow growth with inflation. So it's a slowing economy with high inflation. So that is
Yeah.
stagflation. And what we're coming from is a low inflation, higher growth environment. That type of environment is very conducive for the overall stocks, like technology stocks, general stock market, like the S&P 500 type stocks, and bonds usually do very well in that type of environment. The environment that's coming with a higher inflationary environment, potentially slower growth, does not do very well for stocks and bonds. Because of the high inflation, we get an increasing interest rate environment tied with it. So this environment is very similar to the 1970s, or even before the 70s, where you have high inflation and lower growth in the economy. So
Yes.
Scott, how would you position yourself in this new type of environment? I know we talk a lot about it in some of the previous videos, but what are your favorite sectors and why?
Yeah, so what Andy's talking about, I'll just share my screen with you again. So this is basically it, where you've had very stagnant period. So this is, I'll just send this into something more readable. So this is oil. So this is oil and this is Dow Jones. So above you've got Dow Jones here. And basically what Andy's talking about is the economy was very stagnant for almost 2 decades. So pretty much from 1964 here to 1983, 1982, the stock market didn't move. It had like dips that were quite large actually. So you've had like in Dow Jones, you've had like drops of up to 40% for a period, which is what we might see in the 2020s as well. But what you're seeing is stocks did nothing, and you've got high inflation, which drives up the commodity prices like that. So used oil, for example, if you look at this chart and just going from here to the top here, you've had 1,000% increase in oil prices, for example, from 1973 to 1980. So this is the type of environment that Andy's talking about. And for me, this is just all about money flow again, right? Because money is flowing out. So because the economy is stagnant, what that means is the valuation of the stocks, your general equities in NASDAQ or Dow Jones or Russell or wherever it might be, the general equities start looking unattractive in terms of valuation, using your traditional valuation metrics like net present value calculations or discounted cash flow calculations. And so the smart money, institutional money, starts leaving these sectors and tries to look for a new sector. And we talked about, the different markets that are available, which are basically general equities, real estate, bonds, and commodities. And so they find the most undervalued sector. Right now, I believe it's in commodities. In 1970s, it was based on the valuations and based on ratios and things like that. It was the commodities. And so that's what you would typically see happen during stagflation period.
Yeah. So, and I think this channel, your channel, my channel, we both have channels that are very heavily focused on the commodity, precious metals, So the ones that come to mind right off the top of my head because of valuations and whatnot, like platinum, silver, gold, oil, and other energy related commodities like uranium, natural gas, and coal even, they all do very well in a stagflationary environment where money seeks where it's needed. And last stagflation in the 1970s, we had an energy crisis in the early 1970s.
Yep.
America went into a peak oil scenario where we peaked our production and it started to come down. And then we had to start importing oil from around the world. We had very high energy prices that kicked off that entire stagflation. We also
Yes.
had a demographic that was coming into home buying years in the 1970s called the baby boomers that bought a lot of homes and provided a lot of liquidity into the system. Would you say that the environment today is very similar to the 1970s or maybe a little bit before the 70s, somewhere in that range?
I would say so. I mean, if you look at the signs of stagflation, obviously, if you just Google it, there are heaps of news just around stagflation. This is Forbes, for example, stagflation threats. Yeah. So one day ago, Bloomberg, German minister flags stagflation risk as Ukraine strains builds. You've got this, and on top of this, what you've got is if you just type in energy crisis, Wikipedia, it's something that you can find on Wikipedia already. So it's got 2021 to 2022 global energy crisis. So yes, I believe because, I mean, the fact that the US is drawing down on its strategic reserves is a pretty good indicator that there is some kind of energy crisis. You've got gas shooting up, price is an indication of energy shortages as well. And you've got like gas and coal shooting up. You've got oil prices, obviously, that's shooting up. And all commodities are going up right now, which indicates that there are shortages of these commodities as well as that inflation factor. So I would say it's very similar.
Yeah, and with all of the energy prices going up and the commodities themselves, what you're going to see is that's going to work its way into the inflationary numbers that people measure. That's the consumer price index.
Yes.
So you get into this self-feeding loop where money rotates into commodities, drives the price of commodities higher, which then feeds back into the CPI number and the selling of bonds. So
yes,
it loops back and forth. So it goes, money seeks inflation protected assets, goes into commodities, energy, precious metals, and then the feedback loop of higher inflation through the CPI number goes back to the bondholders and said, I need to sell my bonds, I'm going to lose money. And it goes back into commodities and you get this loop.
Yep, 100%, 100%. And it brings into equation the hoarding instinct, right? Whether it be, by country or by individuals, it brings in hoarding instinct because I think China has been massively stockpiling copper and other essential base metals just recently, because of fear of them running out. So as you see these countries hoarding, right, other countries are going to jump on the same bandwagon and start hoarding the same type of minerals and essential commodities that they need to survive going forward. So I feel like that drives further the prices of commodities, and same with people, right? So if they're in fear of running out of certain goods like food and stuff, they start hoarding more of that. So grain like rice or flour, whatever it might be, if they feel like we might at some stage run out of food, then they start hoarding them, which causes price to inflate even more. So yeah, you go on this massive cycle.
Yeah, and the way that I've always viewed it, and maybe this is an incorrect way to view it, is the start of the cycle happens with inflation. The money comes into the system, liquidity, and then it basically creates shortages because the pricing of everything in relationship to the money that's out there is too low.
Yeah.
So you get this liquidity kind of pump, so to speak. It seeks all these things, and there's not enough things in relationship to the money that's in the system. So it starts driving the price of everything up, and you'll eventually start to see shortages of certain things. And energy is that big driver of everything. The energy shortage and the cost of energy, and then it permeates into everything because oil is the number one commodity. So I know a lot of maybe new people are probably going to view this because a lot of people are looking at stagflation at the moment. What kind of advice would you be giving someone who's a new investor when this type of environment comes? What should they be looking at? How should they approach a stagflationary environment, in your opinion?
Yeah, so I would say first step is to understand the flow of money. So, as long as there's liquidity in the system. So just think about it as, water. So that's kind of how I view it. When I imagine it in my head, and just imagine the Fed either pumping or withdrawing water from the system. And so you've got to allocate that water, right? So the given quantity of water to certain markets, right? Certain sectors within the market. So, as we said, it's always, the biggest markets are bonds, real estate, general equities, and commodities. So you've got to find a place where the water is like bursting, right? Because so much money has gone into it already. And so if you understand that, and if you understand the relative valuations using ratios or traditional valuation metrics in case of real estate or general equities, then you will understand where the money will naturally have to flow. With the given liquidity in the system, you will naturally understand where the money, the only way in which the money can flow. So I think if you understand that, because the alternative to that is everyone holds cash, right? Because you've got the four big markets, right? General equities, bonds, real estate, and commodities. The alternative to all those markets is that you just hold cash, right? As your liquid asset. But in an inflationary environment like this, it's very unlikely that you're going to see someone just hoarding cash, right? I mean, we've seen a period of that, very brief period of that during like Weimar Republic, which was a very high inflationary environment. But I don't know, like with commodity prices, with momentum behind commodity prices like we're seeing now, it's very hard for me to believe that someone's just going to be hoarding cash, right? So I feel like, if you just understand the dynamics between the markets, and if you understand the natural flow of money from I guess, the overvalued to undervalued, then I think we'll understand that money will flow into commodities.
Yeah, and just to describe the conditions that I think that are coming to help everyone understand what potentially could be coming. When inflation comes into the system, things are going to cost a lot more across the board. Labor, like wages, should go up, in an inflationary environment. They may not go up as much as inflation is in the system, but they should go up. You're going to see home prices go up, in my opinion, because of the inflation and the demand. It's the supply and demand of the millennials coming into home buying years that are going to drive up home prices. And yes, I know that mortgage rates are going to affect the affordability, but they're also going to drive prices of new home builds up, which will drive the overall entire market up. And in this type of environment, stocks and bonds don't do as well in an increasing interest rate environment. And the inflation will force bondholders to sell bonds, increasing the yields or the interest rate. That interest rate increasing is going to put further pressure on bonds, existing bonds, to go down in value. So bondholders are very, they want to sell because they don't want to lose money. And what that does is they're going to have to figure out where to put that money into next. And in this type of environment, they prefer to invest in commodities, precious metals, in particular, energy. Energy is one of the best inflation hedges. So on this channel and on Scott's channel as well, we talk a lot about basically inflation hedges or investments that do well under inflationary conditions, which would include a stagflationary environment. And we could see things push and pull and move with markets coming back down. When I mean markets, like the stock market, the S&P 500 may come down, and the NASDAQ technology sectors may come down, and it may impact some of the commodity sectors in the short term. It may pull them down with it. But the environment and the market conditions supports higher prices for commodities and the stuff that we are invested in on the medium term to long term basis, as long as the inflationary condition exists. So the way that I'm investing in it, at least, is if the trend of inflation exists and we have the increasing interest rate environment along with it, what that does is it puts it's called a real negative rate on bonds, which bondholders want to sell. As long as that condition exists, I think money will rotate into where we are positioned. And if you're interested in finding out how I'm positioned, you can sign up on the website, the Finding Value website, in the description link below, join the Platinum membership, and that will get you access to how I'm investing it for this commodity bull market, whether it's energy stocks, other commodities like rare earth metals and uranium companies, and what else that's in there for commodities.
Shipping.
Oh, go for it.
Yeah, no, so that's exactly right, Andy. And so what you'll also find is this is a pretty much a wake up call for a lot of institutional investors as well. So what you typically find during these periods is that they will also rotate money out of highly valued general equities into value stocks. So they will start looking for value, looking for undervalued stocks within the general equity sector. So yeah, so this is time probably to be looking for value stocks as well. And perhaps, I mean, this is a global phenomenon, so it might be a little bit different. But what used to happen historically is when there was high inflation in the US and the US dollar was tanking, we saw rotation of money out of US general equities into foreign general equities. So we saw that, but I don't know if it's going to play out that way, just because this inflation thing is a global phenomenon right now. So we'll just have to observe and see if the money is flowing out of the US into foreign stocks. But I think that's probably something to be aware of and keep an eye on.
And when you say value stocks, what do you mean by value stocks?
So value stocks is, basically, if you look at some of the NASDAQ companies right now, they at its peak, like they were trading at ridiculous valuations, like 40, 50, 60 times their annual earnings was their market capitalization. So using your traditional valuation metrics like PE ratios and price to book ratios, so relative value of the company relative to their earnings or relative to their assets that they own, they were really overvalued. Just using historical metrics. And so what you'll see is, as the money's rotating out of these highly valued stocks, people have to look for elsewhere to put their money. So naturally, they will be looking for, commodities as we discussed, but other areas that might look for, because given commodities not a large market, they also need to find other places to put their money. And so within the general equities market, they will also look for value stocks, which are trading at, say, for example, low price to earnings ratio or low price to book ratios, and they will try and rotate some of that money into there. Because another thing that's kind of important in this environment is what kind of return on investment are you getting in terms of dividends, right? So they'll be looking for something that pays a bit higher dividends. Potentially, if there are stocks that are paying above your nominal interest rate in dividends, that will look attractive. They will start looking attractive to institutional investors. So yeah, there are a couple of places where in this environment, the money can flow out of the tech stocks in particular, for example, into other sectors within the general equities market, or obviously commodities, the main one. So
yeah, and the way that sometimes I look at value and the way that I just kind of view it is they have more earning. You're paying less for the stock compared to their earnings that they are having today. And the ones that you're paying very high multiples, price to earnings ratios, it means that a lot of their growth is in the future. And when they discount that growth back to today for a net present value calculation, they're using the 10-year interest rate for that calculation. So that calculation, if you use a higher interest rate, will actually compress its PE ratio lower, because the growth in the future may not be as valuable when you could have the option to invest in a lower risk, higher returning bond today. So that's how the investors look at it. They look at it like, I can buy a bond with a much higher interest rate today versus speculating on this high growth stock where that the earnings way out in the future may be inflation adjusted lower than what we thought. I'll put it that way.
Yes,
So,
exactly right.
Do you have any other comments maybe for a new investor that they should know about stagflation or anything like that? Because
there are always going to be opportunities in the market. So don't be afraid of downturn in the economy, because in any any condition, in any market condition, there are always opportunities. And so, we believe we have opportunity in commodities, for example. So look for those opportunities and don't be afraid. Just study. I think study. Watch Andy's channel and just study the markets. Look at the history. Determine what is likely to happen based on historical data, and go with the flow and just keep observing, keep studying the markets, because the dynamics of the market can very quickly change as well. So I think it's really important to just keep your eyes on the market, see the market, continue to observe the money flow, and just stay on top of the markets.
And my last question for all the people out there who are watching, since you've made it here, does Scott look better as a dog or as his normal self? Put that in the comment section. I'd love to hear what you'd have to say.
I'd say as a dog.
Put in the comment section. Don't forget to give a thumb up and all that stuff. Subscribe to the channel. Subscribe to Scott's channel too. Don't forget him. And that's all I've got. Thanks for coming on, Scott. Really appreciate it. Even though you hired your dog to come on here.
Yeah, that's right. And the reason for this is, guys, is that I'm in pajamas right now. I just woke up. I'm in this stupid looking pajamas. That's why.
He's
I'm
over
sure you
in
don't want to see it.
He's over in Australia. I'm in America. And we're like, we're probably what, maybe a little less than 12 hours apart.
Yeah. It's completely opposite, basically. Yeah.
He's in the AM, I'm in the PM. So, all right, guys. Well, thanks for making it this far. We'll catch you next time. This is Finding Value and Scott, Sow and Reap Capital.
Thank you. See you, everyone.